Hello and welcome everybody, and thank you for joining us on today's webinar, which titled Building Wealth with Passive Investments. And it's going to be a two-part presentation. I'll do a brief overview of self-directed retirement accounts, and then I'll bring on our guest speaker, Ed Sinicki, who will talk about different passive investment that you can use to start building your wealth. Just a quick overview and my information. My name is Dmitry Fomichenko. I'm president and founder of SenseFinancial.com. And in this presentation, I'm going to share some ideas, some strategies, and here that we are not a fiduciary. We don't provide legal, tax, investment, or accounting or any other professional advice. My expertise is in self-directed retirement accounts. And if you do need professional advice, please seek professional help on that. But our mission as a company is to help our client obtain control over and protect their retirement accounts. And this is what we do. And there are a couple different ways that you can do that. And the options that you have is number one, self-directed IRA, and number two is a self-directed solo 401k. And that's the really powerful option that gives you full control over your retirement account. It puts in the driver's seat, gives you checkbook control and ability to make investments into virtually any type of investment opportunity using your retirement account. So what is just a quick comparison, what is a self-directed IRA or 401k? And the conventional retirement account is held with the custodian who allows you to invest in stocks, bonds, and mutual funds. So basically your investment options are quite limited with just a conventional retirement account. And here's a quick example for you. I remember when I used to work for a company a number of years ago, and we had a 401k there. A representative from the 401k will come up to us about once or twice a year. We had a company meeting, and all of the participants in the 401k were invited to join that meeting. And the representative gave us a sheet similar to this one. Okay. Mutual funds that are available, very, very limited, and you have virtually no control over the investments that you make in. But the self-directed IRA or 401k, on the other hand, basically doesn't have any limits on the investments that you make. You can invest in residential real estate, tax liens, and tax deeds. You can invest in real estate options. You can do mortgage notes and trust deeds. Basically, you become a bank in this case. You can invest in businesses and partnerships. You can even buy real estate internationally. We do have clients who invest in real estate in India, in Canada, in South America, and in Japan now. You can invest in hard money loans, and you can also do conventional investments, stocks and mutual funds. So as you can see, the difference between conventional retirement account and a self-directed one is in investment options. When using a self-directed retirement account, you have virtually limitless investment options. And this is not a full list here on the right-hand side. This is just a list of probably some of the most common investments that people make. List like that doesn't even exist. There's a few limitations that IRS says you cannot invest with your retirement account, and beyond that, anything is available for you and possible. Now, and if you're sitting here and thinking and looking at your retirement account, and if you're probably thinking just like this man here, which says, I finally decided to put something aside for our retirement, and that's our plans to retire. If you're looking at your statement and thinking something like that, then you definitely want to pay attention, because it's not too late for you to make a change. it's not too late for you to take charge over your retirement account. You can do that with self-directed IRA or 401k. And then Ed is going to share with you some of the ideas, how you can put your money to work, how you can be in more control. Because I'm sure you will agree with me, when you put your money in conventional investments such as stocks and mutual funds, you and I, we have no control over the performance of that. And we can look at the history and we can see that the stock market kind of goes up and down, and there are certain trends. But ultimately, when you invest in a private in a publicly traded company, we have no control over the management or the decisions that they make and how that investment is going to perform. But before I bring on Ed, just want to give you a quick example here. I'll show you Jason. Jason is one of our clients. He lives in Tallahassee, Florida. He contacted us looking for ways to change, and he had a couple different accounts, IRA and 401k, totally valued at about $135,000. He was actually losing money. He's retiring. He was just like many of you. He was looking at his account statements and seeing value decline over the years. So he got sick of that. He liquidated everything. And he was also concerned about the way that our government spending just out of control. And he was concerned about the possibility of the government coming after private retirement accounts, just like it happened in Greece and other countries, where government just stepped in and took portion of private retirement accounts, which is possible. It's possible it might happen here. And if you're just a conventional institutional account, that's something that you may need to take a closer look at. And what we did is we set up a self-directed solo 401k for Jason. It is also known as Ultimate Retirement Plan. And he was able to take portion of his funds and invest it into rental property. So his 401k owns this property now. He also took a portion of the money and invested that into real estate note. And now he became a bank, or rather his 401k is a bank now. That investment or that loan is secured by real property, and he collects interest on that note. And that's very secure, secured by the real property. And he's earning a nice return off of that. And then money that he had left, he invested into his brother's manufacturing business. And that was something that his brother actually started several businesses successfully in the past, and he was able to really make that a win situation. And so Jason knew about that, and he invested into his brother's business. So combining his earning about $1,200 a month in passive income right now in his retirement account, huge difference compared to before. And that just doesn't even include the potential of the capital appreciation on his assets. And that's just one example that is available, and you too can really make a makeover with your retirement account using self-directed IRA or 401k. Now, with that in mind, I'm going to bring Ed, and I'm going to switch over to his presentation very quick. And here it is. Okay, Ed, are you there? Okay, Ed, are you there now?
Yes, I believe I am here now.
Okay, great. Ed is now on, so let me just take a moment to introduce Ed. I've known Ed for 10 years, and Ed has a great experience in investing when it comes to investing. He actually started investing about 40 years ago, so he's a veteran when it comes to investments. And he's done really well himself, and now he spends he retired. He spends his time just helping average folks like many of you on the call today just make wiser decisions when it comes to your money. So, Ed, go ahead. Here you are.
Thank you, Dmitry. Well, we're going to talk today about investments that create passive income and to use to meet your wealth goals. Okay. And here's my contact information. And let me also add that Prudent Consulting does not provide legal, tax, investment, accounting, or other professional advice. If you need that type of advice and assistance, please use the services of a competent professional. All right, we're going to talk about 3 different investments today. We're going to start off with precious metals. We're going to talk about real estate, and then we're going to talk about trust deeds. Precious metal investing is something that's been done for thousands of years. It is counterintuitive. Usually when the stock market crashes, precious metals do well. You can check back in 2008 and see how that worked. Well, the most important thing on your investing is to protect your principal, and you can certainly do that with precious metals. You can invest in many, many different ways. You can use your money for stocks, for bonds, mutual funds, real estate, treasuries, and annuities, and of course the precious metals. Okay, here's a little graph that talks about the stock market. You guys have heard about the quantitative easing that's been going on for the last 3 or 4 years. Many people believe that the stock market is being held up by that quantitative easing. It was almost to the tune of $4 trillion, an almost unimaginable amount of money. Some people think that when that ends, which it has recently, that the stock market may take some adverse action. That will still remains to be seen. Okay, here's a graph that compares bonds to inflation. You can see that if you invest in bonds, you get a fixed rate of return, and bonds historically have not kept up with inflation, unlike precious metals, which has actually paced inflation. Now, we do have to talk about real estate versus metals, just to give you a little contrast here. Real estate, while it is a great investment and you can certainly make money in real estate, it is not liquid. If you want to cash in precious metals, whether it be gold or silver, you can do that immediately on any forum and obtain liquidity right away. Real estate, you're going to have to sell. It's going to have to be refinanced. And of course, when you're selling real estate, you don't want to sell when the market is low. You want to sell when the market is high. If you need your money immediately, you may not have the option of waiting to do that, unlike precious metals, which can be liquid immediately. Okay, diversification. We talk about diversification a lot in investments, and diversifying your investments is a way to protect your wealth and your retirement funds. Gold and silver, again, will help you keep up with inflation. It's something that's been going on for just thousands of years, and a lot of people feel very comfortable having a certain portion of their portfolio in precious metals. I think 5 to 10% is actually about the only amount that I would do. All right, let's talk about real estate investing, one of my favorite topics. Here's the advantages to owning rental property. The government wants you to own rental property. That's why they give you all these advantages. You have the mortgage interest, which is deduction, any expenses, insurance, property tax, management fees, and on top of that, they allow you to actually take a phantom loss called depreciation. And the reason the government wants us to invest in real estate, the reason they make it advantageous to us is because they want us to provide clean, safe housing for people so that the government doesn't have to do that. They know that private enterprise and entrepreneurs like yourself can do this at a much cheaper way and much more efficient. Okay, let's keep this in mind always. It's not how much money you make that counts; it's how much money you keep, which is why you have to invest in real estate for part of diversification, because it allows you to shelter your money. It allows you to take tax deductions, and there's appreciation that goes on with the property and the appreciating rents at the same time. You can buy and hold, or you can flip properties. I am a buy and hold and believe that is the best way to invest in properties. You have multiple streams of revenue from different properties. You usually get double-digit returns before your tax benefits. Tenants are the ones that actually pay off your loans. Depreciation works to your advantage. Worried about inflation, but if you own a lot of real estate, inflation is actually your friend. Inflation takes place, property values will rise, and your rents will rise. You can also use buying and holding by using other people's money and OPT, which is other people's time. You can leverage real estate, whether it's in your retirement account or outside your retirement account, and you don't have to spend a lot of time managing it because you have property managers, and that's OPT, other people's time managing your investment. I have property throughout the United States, and I probably spend 6 to 8 hours a week managing that property. What I do is I manage my property managers, not actually the property themselves. Okay. Managing a property manager. Why do you want to use a property manager? Because nobody wants annoying calls in the middle of the night, especially if you own property out of the state, the time difference. I don't want to receive phone calls telling me that the toilet is broke. I want the property manager to get those phone calls. And quite frankly, I'm not a very good property manager. I do manage my properties here in California because they're close to me. But a property manager is a no-nonsense type person. I tend to fall for the, your rent's late for, because my kids need to have the dental work done or whatever it is. And, I'm just not a very good property manager. So hiring property managers is actually a no-brainer for me. Here's my rule of thumb, and I hope it's everybody's rule of thumb. Live where you want, invest where the numbers make sense. I haven't invested in California properties since 1989 because of this very reason. The numbers just don't make sense to me. That's why I invest out of the state of California. But I choose to live in California because I love the climate. I love the state. My family is here. But my investment money now goes on outside of the state of California. All right, let's talk a little bit about trust deed investing. What is a trust deed? Well, a trust deed is a ownership in a piece of the property. It shows that you have that ownership. It is on file at the county recorder's office. It's there for everybody to see, and it protects you. The trust deed is what protects you in case the person doesn't make the payment, because you are the one that is loaning the money to that person. Okay, the benefits of trust deed investing are many. It's a secure investment because, like I said, you have a trust deed on the property so that your property is, if the person doesn't make the payment to you, you can seize the property. That does take a little bit of money. So if you're doing this in any retirement account, you want to make sure you have your reserves just as you would have your reserves outside of the retirement account. These are generally not long-term commitments. We're talking probably 5 years. The immediate return with a trust deed, the minute that you get it, you're going to get a payment. Unlike a rental house that goes vacant, we don't care as trust deed investors whether the house is rented or not, because that's not our problem. We're just the bank, and we just get a payment every time. The yield is steady. The yield is higher than you're going to get anywhere else. It can be 8 to 10% with some points. It's a low-risk investment because you have that ability to foreclose on the property. And you will find it to be less stressful than owning real estate. When you own real estate, you have to worry about getting it rented. You have to worry if the property manager's doing it right. In this, you just have to check to make sure that your check is deposited every month. Now, given that, trust deed investing is part of our diversification. It is my opinion that you will make more money by actually investing in real estate, but we have to diversify. And having some money in trust deeds and having that income coming in steadily every month without worrying about vacancies and repairs is a wonderful thing. Okay, as I mentioned, it removes the stress of investing. A lot of landlords become former landlords just for that reason. Like I said, you're going to make more money in real estate, but having investments in trust deeds is part of the diversification and what we need to do. And it's a pretty much a worry-free approach, and you're still investing in real estate. Okay, let's talk about how it works. An investment company or an individual will identify a house that is suitable to be purchased. It'll either be a foreclosure, an REO, or a distressed property. They buy that property cheap, less than the market value. They then rehab the property to meet whatever the standards are for whatever city and state that it's in. They bring all of the electric, plumbing, sewer, everything right up to standards. If the roof's over 10 years old, they probably will replace the roof. Then they rent the house to start the cash flow. You either can rent it conventionally or you can rent it through HUD or a Section 8 approved tenant. The investor purchases a promissory note secured by that house. That's us. What we do is take a loan. We give the money to the investor. The investor in turn gives us a promissory note. There's a recorded deed of trust. We have title insurance in our name. We have the hazard insurance in our name. You go through an escrow process where all the money is handled through escrow and all of the recordings and all of the paperwork is done appropriately. The reason we have hazard insurance is if the house burns down, we are the ones that get paid, which protects our investment. Again, you get that immediate return on investment called points. Could be from 2 to 4 points. You're paid that in cash at the start, and the interest rate is much higher than you're ever going to see in a CD, a bond fund, or many other type of static investments. Now, what is security? We've talked a bit about the security, but here it is defined by a promissory note. You have a recorded deed of trust. You have the title insurance policy, and you have the hazard insurance in your name. You have the same power, the same responsibilities, and the same protection that any bank has that loans money to an investor. In many cases, you don't want to have to foreclose on the property, but oftentimes that is not a bad thing to have happen to you. You may go 2 or 3 months without payments, but you'll end up owning a house free and clear for your troubles. It's not what we want as trust deed investors, but you also have to look at what the worst case scenario can be, and the worst case scenario is you now own the house. It's not a bad thing. Okay, here's an actual an example. This was a house in Jackson, Missouri, Mississippi, that was purchased for $37,000. The investor, you and I, we got a $1,480 investment fee up front. Over the period of time, the 5 years at 9%, we returned $16,650 for an almost 10% return on investment. Again, much better than you're going to get anywhere in the market through conventional CDs or funds or anything else. This is a perfect way to use your self-directed IRA and solo 401ks to invest. Keeping in mind, when you invest with your solo 401k or self-directed IRA, none of that money is taxable. All right, here's my contact information. Here's my phone number. Please feel free to call me. There's absolutely no obligation. I love talking to investors. I love talking to people that are starting out. I love pointing out to people that creating passive income is the way that we are able to retire. Once you have enough passive income that replaces your income from work, you no longer need to go to work. So give me a call or email me, and we can set up a time to chat.
Ed, thank you so much for joining us and for a great overview of options that are available to investors. We do have questions coming, so let's try to get and see how many we can get. The first question is from James, and he's asking, I'm a new investor. I don't have any investment experience, and I do have money in my retirement account that I want to self-direct. So what would you recommend be the most appropriate for someone like me?
Well, James, I'll tell you the first thing I would do is see if I qualified for the solo 401k. If I did, that is the best retirement plan that you can use for investments outside of the commercial market. If you don't qualify, you can still do a self-directed IRA. What the best investment is really going to depend on how much money that you have in your account. If you have $20,000 or $30,000 in your account, that's really not enough money to invest in a piece of property, but it is enough money to invest in a trust deed. A first trust deed is what we recommend to get that 8 to 10% return on your money. If you have $50,000 or a little bit more, that's enough money to buy your first investment property. You're the kind of person that I love dealing with, giving you the knowledge that you need to pick that very first investment property that's going to make you wealthy over time. This is not a get-rich-quick opportunity, but it's a get-rich-slow opportunity, and it's a safe way to grow your wealth.
Okay, thank you, Ed. Another follow-up question here is, so for someone who has, say, $50,000-$60,000, will that be enough to actually get into real property?
It will be. It will be. There are actually some homes that you can pay cash for with $50,000 or $60,000. Now, remember, you have to keep reserves, whether it's a retirement account or whether it's not a retirement account. So if you have $60,000 in your retirement account or in your checking account, I would recommend that you keep $10,000 in reserves for unforeseen things. I mean, you are going to have vacancies and you are going to have repairs, so $10,000 should be sufficient. You can get a loan. If it's in a retirement account, it's a non-recourse loan, so you can leverage your retirement account, and with 20% down payment, you can get a loan outside of your retirement account. So yes, absolutely, having $50,000 saved or in a retirement account is enough money to start your first investment in actually buying and owning a piece of real estate.
Okay, great. Now, the next question is from, let me read that. Just to follow up, actually, before we get to the next question, Ed, if you can comment on, because we get that question. I get that question asked from my investors and my clients as well. Obviously, it's not. You can buy anything in California for that amount of money. So, what kind of quality property or investment can you buy for that? For $50,000 cash?
If you want to buy a home for $50,000 in cash, you're definitely not going to find one in California. On the other hand, there are many states, Ohio, Pennsylvania, through the Midwest, that have the opportunities to buy homes that are probably going to be 40 years old. I'll give you a real example. I own a home in Toledo, Ohio, that I paid $32,000 for. Now, that was 4 or 5 years ago, so it's probably worth in the $50,000 range now, or at least high 40s. That was a house that was completely rehabbed. It's been rented for $625 for the last 4 years to the same tenants. I've had only one repair during that time. So you're not going to get a new house, but you are going to get a quality home. You're going to verify this because before when you're in escrow, you're going to get a person out there, a contractor out there to give you an inspection of the property. And you're probably going to be buying this type of a property from a company that does it for a living. It's not going to be most likely on the MLS, but there are many, many opportunities to buy $50,000 houses that have good construction, good bones to them, and everything has been updated.
Okay, thank you. Another question comes here actually Marta is asking this, and she's asking, so when I buy something like that in another state, how can I trust somebody out there that I need to actually have somebody locally, property manager? How can I do that remotely?
Very good question, and in fact, probably the most important thing for an out-of-state investor is to have good property managers. Most of the investors and real estate agents that sell properties also have a property management company attached to their selling company. This is an advantage to both you and to them. They obviously want to sell you another property, so they want to keep good contact with you. So they're going to provide good property management to make you happy, to keep you their friend, so that when you're looking at another investment, you're going to use them again. Makes perfect sense. It's a win-win situation. If you don't have that opportunity, I think the best way, and the way I've done it, is to talk to fellow investors that have a property in the area that you're looking for. You can do that online. You can do that through real estate meetings. You just need to get a good referral. You also have to be ready to fire a property manager that is not doing the job that you expect and want them to do, and to move on. Finding a good property manager is key to your investment, but in my experience investing outside of California in the last 10 or 12 years, it's not a difficult thing to do. You just need to do some due diligence, and you'll find that right person. If somebody's investing in the state, in a city where I'm at, I can always give them a good recommendation.
Thank you. And Ed, would you be able to provide those connections, provide those recommendations, and connect us with potential investment opportunities?
Absolutely. I have purchased myself from many of these people. Some of them I haven't, but they're all good people, good investment companies, buying good properties, selling it to investors like me and Dimitri and all you out there listening. And it's really just a win-win situation. And yes, I have contacts throughout the United States that I feel very comfortable recommending.
Okay, great. Well, thank you very much for joining us, and thank you for